Nvidia has just released its results on May 20th, and once again, the company is demonstrating extraordinary growth. More than $80 billion in revenue in a single quarter, almost double from a year ago. Nvidia has delivered another major beat and continues to ride the wave of generative AI, to the point of sitting at the center of what its CEO calls the greatest infrastructure expansion in history. But the market is already looking ahead. Nvidia, one of the brightest stars on the Nasdaq, has surged in recent weeks in anticipation of these results. So now the question is simple. Does Nvidia's spectacular momentum still justify the current share price, or has the valuation run too far, too fast? We are not here to retell Nvidia's entire story. If you are listening to this podcast, you probably already know the company as the leader in graphics processors and AI accelerators. You already know that Nvidia has built a unique technological moat around its GPUs and software ecosystem, and that it has dominated the market since 2023. The competitive and regulatory backdrop has not changed dramatically in recent months, aside from tighter restrictions on exports of AI chips to China, which Nvidia is now explicitly incorporating into its outlook. So the goal of this episode is clear: to assess Nvidia's market valuation after its May 20th, 2026 earnings release by examining its latest financial performance, the strength of its business model, and several different valuation scenarios. On May 20th, 2026, just before the earnings release, Nvidia closed at $223 per share, not far from the record high of $236 reached a few days earlier. At first, results this spectacular sent the stock even higher. In after-hours trading, Nvidia briefly approached $227. But the surprise effect faded quickly, and the stock finished slightly lower, down around 1%, a move that was confirmed on May 21st with a decline of more than 2%. The market had already priced in much of the good news. Nvidia had gained 15% in the month leading up to earnings. Investors also adopted a cautious tone during the analyst call. They likely focused on the fact that Nvidia is facing unprecedented demand, to the point of struggling to produce enough chips, and that some strategic customers are developing in-house processors that could eventually reduce their dependence on the company. Those factors help explain why, after a brief post-earnings spike, the stock saw a modest pullback. Nvidia has a strong balance sheet and performance indicators that place it in a class of its own. Nvidia's firepower is especially clear in its return on invested capital. Its ROIC is above 90%, an astronomical level compared with an average cost of capital of around 9%. In practical terms, every dollar Nvidia invests generates almost $1 of profit each year, while that same dollar costs only a fraction of that amount in financing terms. That figure points to an exceptional capacity for value creation. Nvidia is not known for its dividend, and for good reason. For years, the stock paid only 1 cent per share per quarter, a purely symbolic amount. But that has now changed. On May 20th, Nvidia announced a sharp increase in its quarterly dividend to 25 cents per share, which implies an annual yield of around 0.45% at the current price. It is still modest, but it is 25 times higher than before. This move clearly shows the company's willingness to return more cash to shareholders and reflects strong confidence in the durability of its cash generation. At the same time, Nvidia has also been buying back stock aggressively, $20 billion during the quarter, and its board has now approved an additional $80 billion in repurchase authorization. Taken together, those two decisions confirm that the company is overflowing with liquidity and can reward shareholders while still financing its ambitious plans. On the debt side, Nvidia has an extremely secure financial profile. Gross long-term debt stands at $8.5 billion, while cash and liquid investments exceed $80 billion, leaving net debt to EBITDA close to zero or even negative. Nvidia's earnings growth has accelerated at an extraordinary pace. 5 years ago, the company generated in one quarter what it now produces in roughly 1 month. Admittedly, EPS growth has not been perfectly linear, especially in 2022, but adjusted earnings per share still jumped by 140% year over year. Nvidia checks every box for exponential value creation. With profits rising at a breathtaking pace, the company clearly belongs in the value creator category. Now let's look at how the market values Nvidia's current and future earnings. These valuation multiples give us a clearer picture of how investors are pricing in expected growth. The price-to-earnings ratio, or PE, represents the multiple investors are willing to pay for a company's earnings in the stock market. To smooth out temporary distortions and present a more representative figure, we use an adjusted PE, which at the current share price of $223 comes out at around 38. By comparison, the forward PE based on consensus earnings for the next 12 months falls to roughly 25 to 26. In other words, the market is expecting a strong increase in profits over the coming year. Even though these multiples remain high in absolute terms, they are actually below Nvidia's previous standards. Over the last 5 years, the stock's average PE often traded well above 50, reflecting periods of highly optimistic expectations. The same holds when compared with peers. Semiconductors and cutting-edge AI companies trade at rich valuations, and Nvidia's multiple, while elevated, is still below its sector median of 72. In other words, Nvidia's bright future is already partly priced in, but without any obvious excess. There is no unsustainable premium, but there is no irrational discount either. We can talk about a moderate quality premium, yet compared with its own 5-year average, the stock is actually cheaper than usual, thanks to the surge in profits. The final verdict, however, comes from intrinsic valuation through a discounted cash flow analysis. Nvidia clearly belongs in the category of high-growth technology companies following an exponential curve. Any DCF model therefore needs to reflect that exceptional profile. We use a two-phase approach. In Phase 1, we rely on analyst growth forecasts over the next 5 years. Consensus expectations call for profit growth in fiscal 2027 of around 75%, followed by a slowdown to 33% in 2028, and then a gradual return to more normal double-digit growth toward the end of the decade. That slowdown still amounts to a soft landing. Even under a cautious view, the market is not expecting a sharp collapse after the current supercycle, only a gradual move toward more sustainable growth rates. In the conservative scenario, we use consensus-style assumptions of roughly 75%, 33%, then 20%, 15%, and 10% by 2031. In the optimistic scenario, we assume the AI supercycle lasts longer than expected, with somewhat stronger and more durable growth, for example, 80%, 50%, 30%, 20%, and 15% by 2031, implying revenue of roughly $600 billion in 2030, well above the current consensus of around $500 billion. Under those assumptions, we also adjust free cash flow margins slightly, using an initial free cash flow base of around $120 billion for the last fiscal year and profitability that expands only modestly. It is worth noting that this FCF projection remains prudent. We have stayed aligned with recent management guidance when calibrating both growth and margins, while also taking into account that Nvidia already excludes certain product sales in China from its forecasts for added caution. In Phase 2, beyond 2031, we reduce annual growth rates linearly until they converge toward a perpetual growth rate of around 2% per year, or slightly more optimistic at 2.5% to 3%, reflecting long-term growth in the electronics sector and the possibility that Nvidia retains a structural advantage. For these long-term projections, we use a prudent cost of capital between 8% and 9%, consistent with mature large-cap technology names. The conservative scenario yields an intrinsic value per share close to $230. The optimistic scenario points to a value of around $400 per share. The truth likely lies somewhere between the two, and by assigning a 70% weight to the conservative case, we estimate Nvidia's current fair value at around $280. With the stock currently trading near $223, that is meaningfully below our estimated $280 fair value, which suggests a positive margin for investors. Even after applying a 10% margin of safety, we still arrive at a maximum buy price of roughly $250. The stock is therefore trading below that prudent threshold, reinforcing the view that it looks somewhat undervalued relative to its fundamentals. What kind of performance can investors realistically expect from Nvidia over 1, 3, and 5 years under different assumptions? Here, we consider 3 forward-looking scenarios. In the pessimistic scenario, growth and margins come in below expectations because of supply constraints, a sharp drop in demand in 2027, competitors gaining ground faster than expected, or tighter geopolitical restrictions. In the optimistic scenario, Nvidia outperforms expectations thanks to even faster AI adoption, major innovations such as its Vera CPU expanding the addressable market, and strong growth lasting longer than currently anticipated. In the base case scenario, the company broadly delivers on the path currently implied by consensus expectations. In the table, we present for each of these scenarios the price targets over 1, 3, and 5 years, along with the corresponding annualized returns, calculated both from the current share price and from our maximum buy price of $250. These numerical targets illustrate both Nvidia's potential and the range of possible outcomes. Keep in mind that they assume the trajectory implied by each scenario and a reasonable, stable valuation multiple at the end of the period. For example, 20 times 2031 earnings in the base case. The key is to size your exposure according to your conviction. The more strongly you believe Nvidia will capture the full AI opportunity, the easier it is to justify paying a premium for the stock. At the same time, prudence means not ignoring the uncertainties, technological delays, overheating demand, regulation, and competition from players such as AMD or custom chips developed by cloud giants could all limit future growth and force investors to reassess the multiples. To sum it up, Nvidia has just delivered a historic quarter. The company posted the highest revenue in its history, driven by the extraordinary rise of its AI chips, which pushed data center revenue up 92% year-over-year. Its financial health is exemplary, its growth remains explosive, and it is maintaining strong discipline, with only a marginal increase in costs and record margins above 75%. From a valuation standpoint, Nvidia still looks expensive in absolute terms, but that premium appears proportionate to the company's quality and potential. You do not buy the Ferrari of AI chips at the price of a city car. Our DCF analysis points to an intrinsic value of around $280 per share, roughly 25% above the current price. Even after applying a 10% margin of safety, our reasonable buy price of $250 remains above where the stock trades today. The stock therefore appears to offer a positive margin of safety and a potential opportunity for long-term investors. At this stage, we view Nvidia as fundamentally undervalued, given the strength of its fundamentals and its future acceleration potential. The current share price reflects a high degree of optimism, but not an excessive one. The market still appears moderately cautious about the more distant future. The risks are real, but the risk-reward profile remains attractive. At a level around $223, investors are not paying an unreasonable price while still gaining exposure to the continuation of the AI supercycle. In conclusion, Nvidia represents an exceptional success story, with growth opportunities that remain fully intact and profitability that continues to reassure investors. If the current trajectory holds, patience could be rewarded, potentially beyond what the market has already priced in. If you found this analysis useful, be sure to like, comment, and share it, and subscribe to our channel so you do not miss our next market breakdowns from Stock Lab. The content is provided for informational purposes only and does not constitute financial advice. Some analyses may rely on artificial intelligence tools. Their accuracy is not guaranteed. Always do your own research before making any financial decision.